Welcome to the Techno Fundamental Report for February 20th. Teaching your kids how to invest is a great idea. A couple reasons. One, you help them grow up, but the main reason I'm finding is that when you start teaching your kids about the stock market and realize that some of the most successful investments are new things, something new. Well, young kids and young people, excuse me, tend to find those things, so it's good to teach them so they can share with you. Now, I wanted to show this graph. I thought it was interesting, a little macroeconomics here, but back at the beginning of the country, 1776, this goes back to 1798, 100% of the federal receipts came from tariffs. Now, you'll notice here, it would change over time, but what changed it the most was the fact that we would go into wars. So if you look at the Fed funds rate going back, now back in the 1970s, we had hyperinflation. And the Fed had to raise interest rates dramatically. But the big problem was that during the 70s, you'd get high inflation, and the Fed funds rate would have to go up, killing everybody, investment-wise. And then inflation would get back in control again, and the Fed would cut rates, but then inflation would come roaring back even worse than before. So the risk here is that if inflation comes back in a big way, you can see where the Fed's going to have to continue to raise interest rates. Now back to the federal government and federal outlays or federal spending, and this has a lot to do with interest rates. Back at the beginning of the country, and where we were using tariffs to finance our government outlays as a percentage of GDP was only 2%. And then, World War, the Civil War comes along, and here it jumps up to about 4%. Then we get into World War II, 28%. But currently, it is a whopping 37%. And you can see the breakdown here. The big area is Medicare, Medicaid, Social Security, defense, and so forth. So we have got to get very serious about cutting this percentage because this is the problem. Now, everybody talks about taxing the rich. Well, I just don't think that's going to work because currently half of taxpayers pay 97% of federal income taxes. So you can see by this graph here that over time, the percentage of income taxes paid versus income has just been going up and up and up. Now, just remember that if we can get the budget under control, that's going to make a tremendous difference in what's going on. Now, there's serious talk out there about getting rid of the income tax. And it would be done with cutting, fraud and waste, cutting expenses, using tariffs instead of income taxes. Kind of an interesting concept. I think it makes sense. Most institutions use something called a discount cash flow model, which is where they try to attempt, it's basically a valuation model used to estimate the value of an investment based on its expected future cash flows. Discounted cash flow analysis attempts to figure out the value of an investment today based on projections of how much money it will generate in the future. So what it boils down to is that when you see a breakout in a stock price, it's usually that the institution is not basing its decision on the chart, but is causing the breakout. So the institutions will cause the breakout. Now, as we go through time and we're trying to find the next leadership of the market, because as we get into looking at the market, we're still moving sideways, but it's a hunt and peck process. You're not going to find the big winners right away, but over time, if you just stick with it, keep your losses small, and then let your winners run. But it's a hunt and peck process, and as you remember from this book that I've talked about in the past, The Psychology of Money, he basically says, the author says, most public companies are duds. A few do well, and a handful become extraordinary winners. So you have to go through this hunt and peck process in order to find the winners. E-commerce has been looking kind of good. We've been noticing e-commerce stocks that that are popping up. We'll take a look at one of them here shortly. Now, last week we talked about the income statement. Now I want to give an example of how to use the balance sheet. Now, here's a company here we're just looking at. It's called Nebius Group. It's an interesting story. It's risky, though. It's a risky deal, but you can see here the stock's been kind of breaking out. But when I look at the balance sheet, and I know this company's not making money, and I just want to make sure they're in good shape so that they can make money. Well, the first number I look at on the balance sheet is the current ratio. Now, that's current assets to current liabilities. The standard norm is about 2 to 1. So in other words, you have twice as much current assets as current liabilities. Well, this company has a current ratio of 22, which means they can cover their liabilities 22-fold. So it looks pretty solid. I mean, they've got over $2 billion in cash, and they have very little debt, So use the balance sheet as a way when you have a company that's not making money, but you still want to speculate on the future that they're going to make money. Make sure they can survive today and use the balance sheet for that. So taking a look at the market, we're still in this sideways trading range. This is very frustrating because as a trend follower, that's what we need. We need that kind of trend going. So we're consolidating. We're either going to break out up here or we're going to break out down here. We're just not sure. So it's kind of a good time to be building your watch list and just maintaining things. Here's the S&P. Now the S&P has kind of crept out here to an all-time new high, which is a very big positive. But if you look at the equally weighted S&P, you're not seeing that. So the problem here is that the market has confined itself to just a small group of companies. We're not seeing that broadening out that would really be bullish. Now, interest rates continue to kind of improve here or stabilize at least. The power index is still, in a very, positive uptrend. So it's kind of doubtful that the Fed's going to be cutting rates anytime soon. This indicator is designed to tell you that. Now, if we break down here, that'll change the story. Now, in e-commerce, here's a company called Shopify. They've been around for a pretty good while now. You can see here the buy signal came in here back in November of last year. Stock's been pretty much consolidating. Then we got another buy signal here, and the stock's in an uptrend. It's a $164 billion company, and they work with Amazon. They're like an Amazon in a way. I do use Shopify. So, and we also do own the stock. I have to disclose that. So if you have any questions, please let me know. Thank you very much.